Welcome to Penrose Learning, where we make understanding easy.
You begin by defining your objective and selecting the underlying stock or ETF. Decide whether you want directional leverage, income, or protection. This shapes strike and expiration choices. Next, pick a time frame that fits your thesis, near term for catalysts, longer for trend conviction. Once done, determine position size relative to risk capital and set a max loss. Make sure to choose a strike that balances cost versus probability, so your trade aligns with expected move and risk tolerance. You place the purchase using a limit order to control fill price and avoid unexpected slippage. Watch implied volatility because higher Roman 4 raises premium. Once filled, track delta to gauge sensitivity. Monitor Roman 4 rank and theta decay daily. If the position moves in your favor, scale out at preset profit targets or roll up and out to capture more upside. If it goes against you, cut losses or roll to extend duration. Make sure to document decisions so you can review trade performance later. You finish by choosing the best exit. Sell the call to realize gains or limit losses, exercise only if deep in the money and you want the stock, or allow controlled expiration when premium is negligible. Once done, confirm settlement and adjust portfolio exposure accordingly. If you face problems, failed fills, wide bid-ask, or platform errors, pause new trades, contact support, and use limit orders or smaller size in illiquid strikes. Finally, review the trade to learn what to repeat or avoid next time.
Thanks for watching. If this was helpful, leave a like and consider subscribing. See you next time.